Okay, let's get this get this show started. As usual, I've got a number of things to share, and as usual, Tim Conklin, I didn't get them out to you in advance. Apologies for that. I, I'll tell you, if I ever get that figured out, I'll do it. It's just that I bounce from one thing to the next, just out of, I'm maybe it's my incompetence, but I'm usually planning this in the 30 minutes beforehand. I go back and I look at all the things that we've talked about in the market desk notes, and I try to make sure that I do those things that I say we're going to talk about here in this discussion and demo. Okay, so let me share my screen. And right off, I do want to point out how well, and look, there's nothing perfect. And I mentioned in the note today, you could look at the stocks that have performed best in the S&P 500 and say, well, how come Edge doesn't show me those in the momentum portfolio? And we can talk about that. It's one of the key things, and it's a point, Steve Hicks, that you made too about the importance of having some form of news. And it's actually my last point that I was going to talk about, but since since I mentioned it, I'll note this, that look, news can change outcomes. There is no question. And in fact, our client services team for the core business, Modern IR, did a webinar about how much machine-driven buying and selling there is in the market. There's a lot of it, and some portion of that is consuming machine-readable data. I mean, somebody's always trying to sell that to us, and executing buy and sell decisions on that information. So as Steve Hicks says, it's important to have some news source you got to know. And there's a great example. I butchered the name of the company last week, but it's Agilon Health, AGL. It's a great case in point. Delivered great returns. Then you see short volume rising, and it has an analyst day and it's down 13%. So that if there's the combo, there's the combo. If you're looking at something in the news like Intel, you can look at Intel and there's a bunch of news. Just make sure you check supply and demand beforehand, because the key is being able to keep gains. I mean, you can, gamble and speculate on things, but how do you know whether it's going to have sustainable gains? Well, you don't, but supply and demand are pretty good predictors. And here you look at this and say, well, why is Intel up if the demand is falling and supply has been well above trend? It's falling now. Well, I mean, news can change those outcomes. But generally speaking, that's when I would leave something. If supply is falling, that provides some support to the price. But falling demand, sure, it could reverse. But I would look at that and say, if I were in Intel, which I'm not, I would take the gains and find something else, because at least you have a basis to understand why something is occurring and whether it's risky or not. I mean, clearly it went up because demand surged and supply plunged. That will presage gains. It almost always does. And speaking of presaging outcomes, I think this is what I wanted to talk about right off the bat, is that the data have done a very good job of telling us what to expect. And they're not perfect, but when demand drops below the green line, stocks have a very strong probability, nearly 100%, of rising. There's this one little exception in here caused by a bank crisis. That will change outcomes, there's no question. But the market still did what the data indicated. And we had a very high probability. And now we're getting diverging supply and demand. Is this sustainable? I don't know. It's the end of the quarter. And I want to show you something else here about the predictive nature of the data. Having the best advantage is to know what's coming and then be able to remove yourself as things change. And there's no perfect data set, but this is a pretty good one. But this is why the market has done well. Falling supply, rising demand. The fact that it's staying so high, it's still above, still below the trend there, but it's 51%. And unless that really changes, I think that the upside will come to an end, and it could happen fairly abruptly. When short volume supply is very high in the market, what tends to happen is you have a great time, everything's going on, and then all of a sudden the bottom falls out. It doesn't happen randomly. It will happen at important junctures like options expirations and month ends and quarter ends. This is a big deal. The other part of this predictive nature of the data that I want to point out is just look at big tech. You could look at that and know, well, where's the money going to go into the end of the quarter? Well, it's going to go into big tech. Very low supply, rising demand. It has peaked, and those conditions are changing. This doesn't mean tech's about to fall apart. I mean, this could settle out and stay high. But generally, that is not what follows those conditions. What generally follows is the trend in whatever the money's been doing changes. I'm gonna just go over here, and I think I heard somebody knocking to get in. Oh, we're good. Okay. So the one more little piece of this puzzle. It's my number one point to talk about. It's a reminder, reminder that the data do a very good job of telling us what's going to come. You might recall that you back up about a week, and we had a surge in momentum, and it was virtually all tech. It was telling us that's where the money was going to go. And you could look at the tech sector. You could see that. Go down. This is what you could do. I look at this data every day. I want to know, well, what's happening in consumer discretionary, consumer staples. I'll buy and sell something. I'll tell you about that too. I'll tell you what I've been doing with my poor decisions and good decisions. There are times when I've made mistakes. See tech. Tech rising demand and supply falling. That was a pretty good precursor of what was coming, and it's not bad. The demand is leveling off, supply is fine. This does not tell us that it's about to fall apart by any means, but it could well be the end of this great run for tech. I mean, tech's been fabulous. The NASDAQ's up, I don't know, close to 20% this year. Tech up about, 17, 18% for the year. And will that continue? It would be improbable because of the nature of the money. If passive money, and you could look all across these sectors, it's a 30-day trend, but passive money is everywhere and was almost in everything. Now it's beginning to change. You're starting to see fast trading showing up. Well, that's what happens at the end of a cycle. High-speed machines that sift through all the data and intermediate the trades will know when the buying stops, and they're going to amplify changes in direction. But it's remarkable how well that data told us where things were going to go. So now what's next? We'll come to that, but I'm just going to come up here to consumer discretionary and consumer staples. This is the measure of the consumer. It's not bad data. This is, to me, to some degree, this is where this is next. This is probably the next place that passive money is going to be. You can see passive money is leading consumer discretionary, consumer staples. They're right. They tend to be more stable. Big drop off in supply on both of those, but the levels still are very high. It's over half of the trading volume in these things. So that it doesn't portend gains, but it says maybe that money shifts to things that are more stable. I'm not saying that's going to happen, but it's an important thing to know that you have this great data source to look at that will tell you what the money is doing everywhere and probably what's coming. Okay, I saw I think there's a question or comment, right? Did I see that? Okay, what have I? Okay, did I missed? Okay, there we are. Andrew, seems like there's a lot of tickers with rising short volume sentiment and price. If short volume is over the average, should we expect a sharp reversal? Maybe the price is just moving with the market. But so yes, I mean, it's hard to say, right? If demand and supply are rising at the same time, demand trumps supply. It will continue to rise, but and I can't give you a statistical certitude to the outcome, but anecdotally, we have certainly observed in the broad market when those conditions happen, what tends to follow is at some important juncture, the market lurches. And then everybody looks around and wonders what's happening. Notice how much everybody's talking about, well, I guess the banking crisis is, put it behind us. No, we haven't. No, we haven't. A lot of things have been misconstrued. That people on CNBC have to fill time, and they talk about the market as though it's rational. It is partly rational. There are human beings who make decisions and human beings that program machines. But remember, the great bulk of the money, I've said this before, take the 7 top money managers in the United States, State Street, or sorry, BlackRock, Vanguard, Fidelity, State Street, UBS, JP Morgan, Morgan Stanley. Those guys have that's 7, I think. That's the $42 trillion of assets. 70% of those assets run on models, meaning we had a conversation with our advisors of our managed accounts this week, and I know a lot about the market, and I certainly share our view, but we're following models, right? How much do we want exposed to equities versus other things? And that's what the money does, and particularly into quarter end. You got to get everything square. If you're running index funds and you have a basket of stocks that are not conforming to the performance of the index, you better get it done by March 31st, or you can get fined by the regulators. The regulators don't want you saying in your prospectuses that you do this when your portfolio is not doing it. So a lot of that happens. And money wants the biggest stocks. I talk about this all the time, that 95% of market cap is in the Russell 1000. If you look at the Wilshire, it's even fewer stocks. The Wilshire 5000 is one of the most complete indices of the market, and it's comprised of roughly, the market cap in it is almost all concentrated in 800 stocks. They sample the whole market. There are somewhere around 1,700 microcaps in it, but those microcaps are like 50 basis points of total market capitalization. So there's this heavy concentration. And where are all the big stocks? They're in tech, communication services, and consumer discretionary. What are the best performing sectors of the year? Tech, communication services, and consumer discretionary. And it's not because of fundamentals. It's because that's where the largest stocks are and the liquidity that they can get into. And that what they're concerned about is not price, but following a model. And so then people misconstrue that as an interpretation of investor sentiment, or that they're fear. We're back to a momentum trade. We know that's not true, because if there was a momentum trade, we would see it here. We would see 30 components, and there aren't. And it's there's certainly things that have done very well. These broad measures have done very well. January was awesome. It is a more challenging trading environment now, though, because there isn't the drivers are really passive. It's the size that matters. You could say, well, the Russell 2000 had a good couple of days. Well, it's got to get square too, and it's only 5% of market cap. So in a short order, if you're truing up your tracking to an index, wham, it can lift the Russell 2000, and then people say, oh, small cap growth is popular again. No, it's just people getting their indexes square to the components. So it's just important to know that. Okay, so I want to talk a little bit about these because I'll share with you. So it dovetails with something. Was that a question from the last demo? We talk a lot about volatility as a measure of what kind of return to expect, and if a stock is down half its volatility, very good likelihood that you can produce a return. So this stock has been in the momentum portfolio, and it's like 3.5% volatility movement between average intraday high and low. And I forget who said this, but if it's down 0.5%, well, what certainty do we have that it just doesn't go down another 1.5% tomorrow? Well, there is no certainty. There is no certainty. There are only probabilities. And so I bought this 2 days ago. I mean, I just do what's in the model. It hits 10 and supply's falling. Well, that's pretty good. And it did. It went down for 2 days. Right? I bought more of it, actually. Then today, it delivered the return. It was up 2.5 or thereabout percent. That was of my return, and I sold it. And I sold it because the demand had already ticked down. So I'm already looking to leave. But it did exactly what the math indicated. Not perfectly, It was down for 2 days, down. It didn't go down and then back up and then down and back up. It went down and down and then up. But the read is pretty good. It's, again, there is no perfect solution, but to know that there's strong demand, falling supply, I know how much it moves every day. I know I have a very good probability of producing a return. That's what you want to do. Same with gold, which I sold yesterday, I think. This was a good stock to own, and it might continue to be. There's nothing particularly wrong here. But for me, when any side changes and demand had flagged, I sold it when looking at that data. I'm just going to take the gain. I can move on to something else. But that's using the data. I know about what I should get in terms of a return out of that and what my risk profile is, and then I just don't take any chances. Once the data change, I'm out. My disaster is this, which I sold today, and you'll see immediately why. And I've greatly improved the condition. I talked about missing my exit. My exit was here. It ticked down, and that's when I should have left. And I didn't. I wasn't paying attention. Sometimes I can only do about 80% of one thing at a time. So then I had to take the higher risk of waiting for the next exit. And that can be a disaster. So I held it all the way through to, I knew demand would return at some point because it always does. So demand returned, supply remained very high, not great. It's not great. And so when it stopped rising, I thought, and with supply rising and demand no longer rising, look, that's the best I'm going to get. Now, maybe there's luck and chance and some news or something like that changes outcomes. You can say, well, oil's going up, maybe that'll work. EQT is gas and oil both. But I'm taking what the data give me. And the data say I didn't get all the way back to level, but I sure cut my losses and I'm out. I'm just going to be happy that it wasn't worse. So it's just an example, again, of using the data to inform what you do, and then you make the decision and you move on to the next thing. Comments, thoughts, observations, because probably many of you have done that. And meanwhile, I'll answer, feel free, weigh in. I'm just going to answer these questions. Chris, 0 days to expiration options affect the higher volumes we're seeing. Well, I'm sure they do to some degree. We lost Steve. I'm sure they do to some degree. Keep in mind that options with 0 days to expiration don't really have an associated asset move. I mean, there's no chance for if settlement is, even if settlement were immediate, it's just very difficult. But certainly it compounds volumes. Yes, for machines that are trading multiple things in multiple markets, exchange traded products, it's gonna do that. So it certainly could. But I think a lot of it too is this quarter end. That look, everybody wants to get the book square. Hedge funds, they're doing stuff by the month because they send statements out. They're very, if you've had a good period, you're going to want to lock those. It's been a very good stretch for tech. Do those firms want to lock their gains? I suspect so. And all of that contributes to volume. But there is a strong possibility that more banks will fail. Are you still? Yes, of course. The problem continues to exist. The assets that banks are holding that are longer, just like the Fed. The Fed has all the same as $5 trillion of assets that are dated 5 years out or more. And those things have experienced a dramatic decline in value. Now, they don't have to mark them to market, but they have to pay interest on stuff now that they're holding, or that they're excess reserves and reverse repurchases, and that the higher cost and the lower value of the assets is troublesome. And I think that's going to come back around. We'll keep a close eye on the financial sector. That will probably tell us. We can look at the data because the data will reflect every known input, and we can look at supply and demand. See, it hasn't been 30 in the month, and I agree. We haven't seen 30 since January in momentum. It's not been a momentum market. And you could say, well, but tech's done so well. It has, but it's been concentrated, in the larger stocks, no question. Okay, let's go back over here. I'll move on to point number 3 here pretty quickly. I just want to look at the financials. So bear with me a moment here. Like it's running kind of slow today. It's Microsoft Azure. So if there's something going on, it's Microsoft's fault. So looking at that, you'd say, well, there's the money coming back into financials, but the supply side is still very, very high, 50.6%. Might be interesting to click through here and do a sort. You could do a sort on short volume and see, how many of them are. I mean, there's an awful lot of banks that are 60, 70, 80% short, and they're all a bunch of small banks. So I think, yeah, we're going to have more trouble. I don't know to what degree, but it's by no means over. And even if the Fed ends up cutting rates, which I expect it will, I mean, they're going to have to decide, as we said, do we continue to hike rates to combat inflation, which is, by the way, that's a misnomer too. That worked when the Fed wasn't creating money. So when Paul Volcker did it, the Fed wasn't monetizing government debt. And so lifting the interest rates caused people to save money. You take money out of circulation. That was the whole problem. We cut loose from the gold standard in 1971, and all the purchasing power collapsed. So you have soaring inflation because there was too much money. We'd issued too much money against the gold stock to the point where we could no longer redeem dollars in gold. So then inflation exploded. What do you do to take money out of circulation? Well, you get people to save it. So you lift interest rates to 20%. It reduces the creation of credit because we have a fractional reserve lending system. Now, if I have $100 on deposit, I can lend 1,000. Where does that come from? That's fractional reserve banking. It's created. So that brought inflation down. We do not have the same condition today. I mean, so lifting interest rates can constrain the creation of credit to some degree, but will it really bring down prices if we continue to spend more than we make? I don't know. So it's not the same condition, and it's not a good comparative. Let's go to March. I said, might we want to be in cash before the end of the quarter? I'm down to my hedge. So the only thing I have left is my short hedge. Look, the market might soar. I don't know what the market's going to do. I look at broad sentiment and say that's pretty good. But the end of the quarter and this extremely high level of short volume that we've had and the absence of momentum means it can end suddenly. And I'm not saying that's going to happen. You could go back and look at each time that there's been month-end securities that have lapsed. Maybe that was VIX expiration. So here's an example, right ahead of the banks. Here we had a soaring market. And you could go back in time and look at that. The trailing data is not necessarily a good indication of what will come. But what has been true over all of this data is this continued trend up to these extreme levels of supply in the market. So if everybody has been trying to get their measures square into the end of the quarter and they stop, the market could tip over, even though the data at these levels don't generally portend that. So I don't know, but I'm a cautious individual generally, and so I've moved. I'd rather be sitting on cash, and then I can always come back and buy something later. But these are important junctures, and so that's how I think about it. Questions, comments, observations?
Yeah. Yes. Yeah.
Fire away, Steve.
If you go back and you where we can see all of the various, yeah, there you go.
Okay.
Have you or anybody that's on here ever done just sector buying? Because it just crossed my mind as you were going through all of this, that as you watch the passive move from one place to another, I don't know if there's any way that you can go back on MSE to see what, like consumer discretionary, when did it move from fast trade to passive? But that would really, if you were doing sector buying, that would be really, really valuable information in order if you're just wanting to move from one
Right.
sector to another using MSE.
I agree, and it is one thing that we lost from version 1.0 to version 2.0 because we changed the entire underlying technology from server side to client side. And there were some things that didn't work. You used to be able to do that, right? You could change the date
Right.
and go back and look at things. And I'd like to figure out how to bring that back. It is very much on my list of items, but it's not currently there. So, what do we do instead, right? We're kind of limited. That is, it's the reality and it's the shortcoming. We've got this 30-day window all the time that we're looking at, but 30 days is a pretty good indication. And you're right. And certainly I've traded emails with folks who do, I don't know if any of them are on this call, do use sector ETFs, even levered sector instruments this way. And it would be a pretty good way to do it. You could look at consumer discretionary, consumer staples and say, well, those levels are really high, but that divergence could mean discretionary and staples are good things to own as Q2 begins, that's where money's going to be. You could make a strong argument against it. You could say, well, if consumers are hurting and we're going to go into a recession, why would you buy consumer stocks? I'm just saying that's what the math indicates, right? But yeah, agreed. It's a good point.
Regarding your Fed discussion,
Mm-hmm.
PBS just came out, and you've probably seen it. It's a 2-hour show. You can get it off the internet. Barry Bailey actually turned me on to this. And,
Good job, Barry.
it's on the history of the Fed all the way through the Silicon Valley collapse, and it is enlightening.
Thank you for the tip. I will look that up. I think it's important to understand how the monetary system works because it has such an effect on the market. So that's good. It's good input. Let's see. So I've got two more things here, and and I want to make sure I answer questions too because I want to not go long like I have been here lately. Anything that I have missed? Jason, thanks for him. And I don't yet. You're welcome. I'm hoping for good, but I think if we were in a bullish uptrend, this would all work a lot better. Not sure in the sideways bearish markets, because I can't. Yeah, it's more challenging. There's no question. It's been harder. Maybe, and if those of you veterans are finding ways that work well, I am too. If the data aren't there, then I'm patient, and that's part of it. The part of it is if the market isn't giving us reliable opportunities, that by itself is a message. But it's a fair point, Jason. It absolutely is. I can't. Low volatility has not worked great, and certainly the momentum portfolio hasn't given us many opportunities. The ones it has, I think, have done pretty well. I try to go back and check that. Look at the things that the math gives us, and I'm always looking at my own performance and how that works. And far and away, my best two performing assets are real estate and short-term trading. Our highly paid professional advisors are woefully underperforming the stuff I'm doing with Edge, and Edge is the only thing I use. Yeah, I agree that commercial real estate is a big problem. There's no question, Tim. Yeah, you're spot on, and it could get very bad. So yeah, there are all these things that should give one caution. My advisor said to me, because I'm not bullish on equities and I'm not bullish on bonds. I'm bullish on 4.5% interest. That to me is a pretty good thing right now. And short-term trading. I'm consistently, except when I do mistakes like EQT, generating returns with short-term trades. And I do exactly what is, if the opportunities are limited, then I don't do much. If they're plentiful, then I use them, but I'm just use the data that Edge provides there. Alex, for 25 days, yeah, pretty close to it. I forget exactly when I bought it. I have to go back and look. Yes, I should have sold it within 3. Really, that's pretty close to what I like to do. You capture something getting to 10 with the diverging supply. The Hicks rule works very well. Take the 2% and keep. It's crazy how that multiplies. I trade $50,000 or so, and I very quickly can add thousands to that if I'm disciplined about doing that. Take the gains. I tend to buy bigger positions. So if there's something there, and Barry, I'll come to you next.
Cool.
There's a strong divergence. I'm not buying 10 shares. I'm buying hundreds of shares of it. That hurt me with EQT. I own like 700 shares of it, right? But if I'm going to do something, I tend to do it in pretty good size because that produces a return. In 2-3 days, you've got a very good return. I owned LNTH just for 2.5 days, but I bought quite a lot of it and produced a good return. Barry, go.
Okay. I just want to confirm volatility. That is based on 30 days, correct?
It is. Yep.
Okay, perfect. And then just a side comment, I play, in both directions. And the way I play momentum is I take the momentum portfolio and I've reversed it. I keep all of the same liquidity factors, so it picks up the same liquid stocks, but everything else is 180 off. And so with it at 10, and it's ahead of both volatility and momentum, I know that the market is going to be challenged. And so like today I was able to play AMD and Coin because they both came up in the negative momentum trade. So it's kind of a way to balance them because it really works good between gauging where momentum is at and where volatility is at. You've got negative momentum, and when it's higher, it's going to be a more challenging market.
Very good. And nice to see you, Barry. Glad the
finally got the
camera's working. Good input. And by the way, I'll just show you this. This is the system portfolio criteria for momentum. And what Barry is saying, he just does these exact opposite for a short trade. And if you can do that, you can trade both directions. That it gives you twice the opportunity. And I'm as I said, I don't short stocks, so I can't. I like to only speak to the things that I understand well. But I have been using SH as a short hedge, and over much of the last several weeks, it's been the good contributor, really good contributor to returns. Okay, let me see. Did I answer everything? Not quite. Okay, Andrew. For Eddie, when you click on the consumer stereo, it would be nice to see the sentiment demand over more. I agree, it would be, and I can look at that. It's because it's client side. All of those things have to be fed back and forth. It's browser based. It's part of this Azure Blazor technology. So we have to sort out how to do that. I would agree that it would be a very nice thing to be able to do. Okay, good. Okay. I think I've got all of those. Last thing, and I'll let you guys go, is this, and I've sort of addressed this, and I think we've talked about what's ahead for the, I don't know what's ahead. I will just reiterate that this is an important juncture, and it might be just fine. We transition into Q2 with this kind of supply demand divergence, and maybe we continue running, but it could end suddenly. So if you are concerned, I will just offer this cautionary note. It's why I only have a hedge left, is because, look, I can always come back and buy something. I know this is an important turning point. I also know, looking at the data historically, that March and September, these rebalances at March and September have very significant weight. And so they can produce big changes in the way the market has moved. And tech is a major part of the market. Tech, consumer discretionary, and communication services are over 50% of all market cap, and they've had a great run in a very challenging environment. And if they stop, then what? So if you are a conservative, cautious individual, then you should be very careful here at this juncture. And I think that's probably good. Any last comment? We'll take one more minute if there is. Otherwise, we can call it good for this time. And we'll see where we are next Thursday. Good enough? Okay. Well, it's very good to see everybody. Enjoy the weekend, and I'll see you next week.